prior to the last 25 years, particularly the last 15 years, I should say, the stock market would reflect the economy. Well, what's happened in the last, and particularly the last 10 years, and because of the Federal Reserve and the fiscal policies we've done and everything, it's all to get the market up, okay, the asset side. So now the economy reflects the stock market. It's reverse. And that means people are spending money because their stocks are high. They're spending money on their children because their stocks are high. They're flying their kids places with them, buying new things. If you go look at the spending, it's coming out of the market. In our opinion, it is. It's not coming from the economy because everybody's feeling great right now because their assets are so high. The real estate really hasn't gone down that much, so they feel good about that too. And so it's one of those things where, you know, it's back like 1928 or 29. The theme was happy days are here again. And it's sort of like that. People are not thinking much about risk and they're just spending money. Well, that's the biggest threat. You get a break in that of any significance the last 2 years or something like that, and you'll change the entire economy because that's what's driving the train right now. You know, what the incoming President Trump is saying is that he wants to, put on large tariffs. Who's to say whether that's a negotiating tool? He would actually do it. And if you look at the people that we import the most from, it's not China, it's Mexico and Canada. So you have some situations that will probably change. But I think a lot of the emerging market countries and a lot of foreign countries are sort of tired of the U.S., the last 20 years, basically beating them down, using the dollar as a hammer on them, confiscating funds and things like that. So they've had a lot of those countries basically turn against them. And if I talk to my friends overseas, that seems to be part of what they're feeling right now. It's harder for the average investor because they are not in the business of shorting and they don't really understand that real well. But if I were the average investor, what I would do, and the best hedge on those kinds of things is just to raise liquidity. And a lot of people say, well, you can buy this strategy or that strategy. But for the individual, the best thing for them to do is to raise liquidity, buy some short treasuries, short term, less than 6 months or a year, and just have a safety valve. And you ought to be looking for really good values. And that's one of the problems today, is that we have an entire group of people in the industry that, I hate to say it, but they're fairly incompetent, the people that have been around the last 15 years, because they don't look at private companies, the individual companies, they don't look at individual bonds, they just buy a bunch of ETFs and indexes. And so when the markets break or things get cheap, the only thing they will know is that price. It's just a number for them. And so they know nothing more than just to sell it. And that becomes a problem in the marketplace itself, because you have very few people today that understand how to buy a business that produces cash flow. We buy in our company, we buy companies. We don't buy the exchange traded funds, or we don't buy the indexes. We buy companies. We know the companies that will pay us the most money the next 10 to 15 years, and we'll buy companies that pay us a lot of cash flow, but we know what we own. That's entirely different what's out in the marketplace today. Let me just say our biggest holding right now is the Treasury. We have 3 strategies, and all 3 strategies have, just on average, they have about 50% in short-term Treasuries. By that I mean less than 18 months. We don't know what's going to happen with the interest rate thing. We think that where we're headed right now, with all the debt that's coming due government-wise the next 2 years, that the Fed will probably have to lower interest rates quite a bit on the short end to really take the interest cost that's coming due. In other words, if you take what's going to refinance just the next 2 years, call it 15 trillion, and the rates would go up a lot. Right now, we're spending 25% of the receipts that come in from taxes just on interest. So you imagine what happens. That's one thing. Second thing is stocks are priced very, very expensive. We have a very mixed, but you'll see where we own industrials, we own a lot of energy, we own healthcare, we own utilities, we own some gold and gold miners too, but in 2 of the strategies. But that's how we structure around that. But the biggest thing we own is short-term liquidity, which is a safety valve for us. And not because we wouldn't buy them, because if we screen companies, we have 250 companies we screen. If they're too expensive, we just don't buy them. And most of these companies today, good companies though, but they're priced too expensively. And so it's not a thing that will give us a great return. It's an interesting phenomenon in the U.S. market. If you take investors that invest in real estate and private businesses, oil and gas, they always look for cash flow. There's so many things they would not buy if they didn't have the right amount of cash flow. But yet they'll go into the marketplace, stock market, and chase price and buy things that have very, very low cash flow and sometimes no cash flow. So it's interesting to see what people do and how they think relative to those investments, relative to the stock market. One of the things people think about, they are starting to realize that the foreign central banks, are saying, hey, look, we're going to back more and more what we do with gold. We don't really trust the U.S. government. Obviously, when this started back with the Russian confiscation of that money in the SWIFT system, and they're basically like, hey, if you can do that to them, you can certainly do it to us. So we're going to gradually try to get away from there and trade in something else if possible. Now, that doesn't mean they can 100%, because you've got to trade with a dollar in a lot of cases. But I do think that if they put tariffs on these countries and really put the press on them, that they'll probably buy more gold than they're buying now. I just think gold is still undervalued. And if you look at the gold miners, price to cash flow, they're very cheap still, even with this move. So I think that's what people probably underestimate. And people are real shaky right now because they've had a little selling. But when you buy gold, you have to be a long-term person. If you're going to own 4 or 5% of it, whatever you want to own, you can't trade it like a stock. Most of the countries that we do business with, their debt to GDP is really high. And if you look at 25 years ago, Germany was a country we could always depend on, for example, that had it together, ran the right kind of money, did the right thing. And then they really got messed up when they joined the EU because they bought into all of that liberal money situation, and that's really messed up their economy now. So you have a lot of the European countries and then a number of the Far East countries too, where debt to GDP is really high, and it's really high in the U.S. And there's 2 ways you can do it. You can't use austerity, because what happens is you'll throw yourself into a real depression, because if you cut back all of a sudden, and I think you will see what happens in this administration with wanting to cut out a lot of things. It will have some shocks to it. But the other side of it is that most of the time in the history, if you look at it, that most countries inflated their way out of it, so that if you look at it, what happened is the inflation stayed higher than the interest rate. So what happened is you end up deflating the dollars. So you're paying it off 15, 20 years later or so with lesser value of a dollar. In other words, you just inflate yourself out of it. If you go back and look at the Bloomberg Commodity Index, if you were buying a stock, you would buy that today. You would say, well, it's been a long time since that really got up and ran away and that sort of thing. Now, for us, we own the metals. We own 2 fertilizer companies. We own some copper. And then if you look, we own energy, a lot of energy. Even though it may have some short-term situations that will change it somewhat. Everybody says, well, if we go into a recession, it will weaken. It will. But there's so much going on in the Mideast right now that I think people forget to factor in the fact that anything there that changes at all, and it will really impact the price of oil. So we've got exposure to oil, we've got exposure to natural gas. That's how we do the commodity side for sure. It's not like the whole portfolio is like that, but a good piece of it is. Probably 30% in our one strategy. Well, if you look at technology today, it's highly owned by everybody, very, very expensive. On anything you want to use to look at it with, it's very, very expensive. And usually when these correct, they give you large corrections, not just small ones, but big ones. And I think since everybody's in that area, that when they go to come out of those and maybe go to industrials or metals or materials or something like that, that what will happen is they'll sell those down pretty hard, just like they did in 2000 to 03. NASDAQ 100 lost 85% of its value. But everybody was caught up in it, and I think they are caught up in it now. We're not as high on the financials. I mean, they may do well, but you have to realize that a lot of the money they make is either from trading the market or investment banking, and the other side they do is on the banking, true banking side. And while short-term interest rates going down would help them, what's happening is if you have a slower economy, just, hey, my spreads are better, but I don't have anybody to loan it to. Well, you have 2 segments on it. You have multifamily apartments, and then you have residential, which is so-so. And in residential nationwide, you have some spots where it's okay. Oddly enough, like Connecticut or somewhere like, there's different places where it's really doing okay because they were sort of late to the party anyway in some respects. But all the hot markets that were before, and I'm talking about the Southeast, Southwest, Midwest, they're not as good as they were in residential. And so you're seeing people drop the pricing. It'll be interesting to see because we'll be coming up on 5 years pretty soon of those really, really low interest rates on mortgages. And for families and that sort of thing, there'll come a point where they get large enough. I'm talking about the families. They're young, but say they had 2 little ones. All of a sudden now they have 3. They're big and bigger. They're going to be sort of forced to try to move into something differently. And one of the things today that people do, and I've lived through this, by the way, so I can tell you, from 1977 till basically 83, I watched interest rates go higher and higher and higher. My first home was an 18% mortgage. It's reversed now. Now the price is too high. You could have a 6.5% mortgage and do okay, but if you look at the pricing, that means your taxes are too high, your insurance is too high. So that whole thing throws the market out of place. Now on the multifamily side, I'm talking about the commercial side of apartments. We're seeing a lot of what we call direct lenders that are selling things really cheap that they had to take back. This is not CMBS, like commercial mortgage-backed securities. These are people that had a direct loan to an apartment complex. It's not working. Now you can show up and buy it for 25 cents or 30 cents cheaper than you can build it. Well, that part is starting to show up, okay? And we're starting to see a lot of bankruptcies on the multifamily side. There's a lot of stuff going on there, but it's different in different markets. I mean, if you take a market like Raleigh-Durham or certain markets in Florida, Orlando, Tampa, places like that, certain back out west, they're doing okay in multifamily. But you take markets like Austin, Nashville, Kent, different places like that, it's not good. They built too many units, and so it just depends on where you are.